On the phone with me right now is Nomi Prins, the author of Collusion. Is your book out already, Nomi?
It's actually going to be out on May 1st. So it's in that pre-order state where I'm done with it. Things are happening, but it'll be out officially on May 1st.
Well, I think you need to change that date to May the 12th. So it needs to come out on my birthday.
I'll send you a copy for your birthday. I'll sign it for you, Lynn.
That'd be awesome. I'd appreciate that. Well, Nomi Prins and I met in Florida last year and have been communicating back and forth ever since then. And I appreciate your insights. She's a longtime Wall Street insider, understand what happens on Wall Street. I want to talk a little bit today about the Federal Reserve and what your takeaway was from Jerome Powell's, testimony today as his first presser. What did you take away from it?
The biggest thing I actually took away from it was that he didn't appear to be as hawkish as some of the media was thinking he might be. That he would come in and sort of turn the 180 away from Janet Yellen's Fed and start to be more predictive of accelerating rates, talk about an economy moving more quickly, make sort of predictive comments to that effect. And he didn't really do any of that. What he did do, which was interesting, was something that really wasn't discussed in much of the media ripping apart his speech since then, which is that he talked about trade wars a little bit. And I took away from that he is not necessarily taking a political stance as to whether trade wars are good or bad. I mean, his stance is actually that they're not so good, but he's taking a monetary policy stance, which is that he's saying if they happen, if they increase, if they accelerate, that's going to create a situation where the Fed might actually have to, and he didn't say this is reading between the lines, the Fed might actually have to specifically not hike rates as quickly as the forecast of 3 interest rate hikes this year has been, because they're going to have to contain the level of the dollar. The general rule of trade wars is to keep your currency cheaper than other currencies,
sure.
and sort of that's basically how you play. And so, although he didn't take a position specifically connecting trade wars to rates, that's actually, I believe, what he was implying. And I think he was implying that for 2 reasons. One, because of what might happen from a trade policy perspective, but also because I don't think the Fed really, truly believes that there is that much growth or real growth happening in the economy. They've been wrong in their last 3 years of forecasts for growth. They've predicted growth, and they've undercut their growth.
Yep.
They predicted interest rate hikes, and they've been off of their interest rate hike prediction. So there's no real reason to assume that this is going to be particularly different as the year unfolds and into 2019.
Well, I think that's a great point you bring up. I track ever since 2011 when the Fed started publishing their quarterly kind of forecast. I've been tracking that ever since. You're absolutely right. I mean, when you go back and look at 2011, they were expecting 3% and 4% rates of economic growth. Now we're down to 2%, and then hoping that we can just maintain that. It is interesting to see Jerome Powell come out today and make the statement, says, well, the economy continues to improve. Everything looks great. And I'm sitting there going, really? Because we just saw the prediction for economic growth go from 5.4 to 1.9%. And 3 straight months of negative retail sales. I was actually kind of surprised that he actually hiked rates. I knew he was kind of in a box to have to, but it seems a little bit dangerous at this point to be hiking rates because, when you lift interest rates there, I mean, the first thing it impacts is consumers on their credit cards, and you're already seeing 3 months of negative retail sales, which has only happened 5 times previous to now, going back to 1990.
Yeah, no, that's true, and you're also seeing more delinquencies coming into credit card rates where they already were. So there's definitely, credit anxiety within the consumer base, and there are reasons for that. And of course, if you do raise rates, that impacts credit cards. It impacts people first. Companies tend to be able to ride out some of that, or at least the larger companies that have borrowed so much. But I think I agree with you. He had to continue with policy. He came in with such an expectation of being hawkish that had he actually not done anything with rates, it sort of would have completely detracted from that mission of him being slightly different from Janet Yellen, which was the entire point of him coming in to be the new chairman of the Fed. The reality is we haven't had a Fed switch, a chair switch in many of the last presidents in the middle of a new administration, in the beginning of a new administration, in the middle of a Fed term, and he did that. So he couldn't really go back on that. But it was also very tiny. If you were really hawkish, if you really believed in growth, if any of the wording of the accompanying announcement that happened with the FOMC directive were something to the effect of things are really great, they could have done a 50 basis point move. So, the fact that he did 25 basis points, which is the only incremental movement that's been happening since the first one in December 2015, really just means absolutely nothing in terms of taking a stand.
Right, and see, and I think you made a couple of statements, and I just want to make sure the listeners that are listening to you right now kind of understand this, because he's saying that he sees economic growth and he's lifting rates. But part of this really has to do, and I think this actually may feed into a little bit for you to promote your book on collusion. How much of that feeds into maybe a tap on the shoulder from the administration saying, hey, don't screw this up, because if the market tanks, all my policies are going to tank with it, and I've got 2018 midterms coming up, and I can't afford to lose a lot of seats, so don't screw this up, Jerome.
Yeah, I think that's a big part of it. And I also think that goes back to the thing about trade wars, which is that he's giving himself room to not necessarily even hit the 3 interest rate hikes that the Fed predicted at the end of last year would happen this year. And that happened in the beginning of 2016 as well. The first rate hike that happened by the Fed was after years was 2015, 25 basis points in December. Market tanks in the beginning of 2016. The Fed had forecast 3 rate hikes in 2016 and produced 1 a year later. So there's definitely precedent to work with the markets as opposed to any kind of economic indicators, whether they're better or worse than is initially forecast into any one year by the Fed.
But Nomi,
wrong every single year.
Yeah, but Nomi, I mean, the Fed repeatedly said that they're not concerned about the financial markets, that they don't focus on the financial markets. So are you saying that they actually do care what the market does?
Well, you and
I'm
I
being
know
facetious,
this,
by the way.
Yes, I know. And by the way, you can call me Nomi. My friends call me Nomi.
All right.
I think that, yeah, I mean, they obviously care about the markets, and as you just mentioned, Trump cares about the markets. Any administration in power cares about the markets not tanking into all of the elections, into the primaries, into everything that's happening, particularly right now, when any potential swap from a Republican-based Congress to a Democrat-based Congress would be detrimental to the policies they've already invoked in the beginning of the Trump administration. So there's and plus again, nobody wants to lose that edge. So no one wants the market. No Fed chair, no head of a central bank, no president, no prime minister wants a market to tank on their watch. And the easiest way for a market not to tank in this particular environment, and in the environment we've had over the last decade, is for the Federal Reserve and other major central banks, and this is where I get to plug the book, collude to ensure that the cost of money remains cheap for all of the sort of major operators, the big banks and the hedge funds and other types of speculators that act in those markets, that require the least amount of cost for the most amount of money they can get to dump into these markets to keep them primed and to keep them high.
So, Nomi, tell me a little bit about the book. What's the book about?
So the collusion that title refers to is actually among the central banks. So basically, what I did was I traveled around the world and talked to specific central bankers and former finance ministers and so forth in different countries that are most impacted by this decade of cheap money, of quantitative easing, of the Fed buying bonds by fabricating money. We'll call it fake money, to basically buy assets, pump up the markets. I just came up with that. No, actually, someone told me. Anyway, the point is that it basically has...
Nomi came up with that. We're giving her complete credit for fake money.
Credit for that. It's good.
It's now recorded.
Thank you. You here first. So effectively, the Federal Reserve, in the wake of the financial crisis, 2008, went about and cut rates to zero, and then instituted this multi-trillion-dollar buy program. It didn't buy bonds with money, it bought bonds with electronically fabricated money. And what this had the effect of doing was allowing the Treasury Department to issue more debt. It had the effect of allowing all the banks that were crucified by their own hand into the financial crisis to dump their really worst sets of mortgage bonds into the Fed, like the equivalent of dumping the lawnmower that doesn't work in your garage sale to someone who's going to pay top dollar for it just because they think it's pretty, or because they have money that's not theirs to buy it with. And that's what happened with mortgage bonds. And this kind of had a collusive effect throughout the world, because the Fed said, you know what, if we're going to make money so cheap and we're basically going to fabricate funds to buy debt that is not worth what we are paying for it, well, then all the other major countries better do the same thing, because otherwise money is going to flow out of the U.S. too quickly into other countries. And so what my book does is that I did a geography. I traveled to these places, but I looked at the 10 years since the crisis in different ways, in different manifestations, and how each central bank, particularly in the G7, and particularly the European Central Bank and the Bank of Japan, were actually coordinating and colluding with the Fed to make sure that if the Fed did something, they did something. And if the Fed screwed something up, they backed the Fed up. And so you have this multi-prong approach where ultimately over 10 years, $21 trillion, in other words, the entire size of the GDP of the United States was fabricated out of nothing to go into the private banking system and to purchase debt and corporate bonds and mortgage bonds, and in the case of Japan, stocks through ETFs and different kinds of financial forms out of nothing. And so in order for this to have worked, they had to work together. And that's where the collusion comes in.
Well, and this is interesting because, if you're doing something, let's say that we're going to pour gasoline directly into a carburetor of a car because it's not starting right. And so, you get the car started that way potentially, and you get the engine running, and so it starts to run on its own gears, and so you stop doing those type of things. The problem I see here is that with this collusion that you're talking about, they did this, and even when the economy started growing again, they kept doing it. And now, here we are 9 years into an economic expansion, second longest on record since the 1800s. And now they're talking about trying to reduce that collusion in the system of providing all this monetary intervention under the assumption the engine can now run on its own. But we're watching interest rates start to come up on the 10-year Treasury. They're lifting interest rates on the short end. You've got the LIBOR, very, very kind of the equivalent of the Fed rate, and actively traded rate, spiking up higher, which higher interest rates slow economic growth. It seems like they've created a bad situation here that only ends one way, which is another recession. Am I wrong about that?
No, that's precisely right, because whether you believe that sort of the indicators of economic growth are accurate in any one of these major countries, the reality is it's had a stimulated effect because of all of this fake money, all this fabricated money that's gone into the system, and that has distorted the bond markets and the stock market. So you have all this extra money, and then on top of that, more money is borrowed cheaply. So companies are basically increasing their debt burdens in order to have extra money at these cheaper rates in order to buy their own stock, and so they do that, and so their stock goes up, and at the same time their debt burden goes up. So now if you start to raise rates just even a little bit, they have to somehow pay back that debt at a higher cost. And if they haven't grown the profitability of their companies to be able to cover that extra cost, even if it's tiny, they start to have to close things down. They start to have to fire people. They start to have to, take back some of those shares, and then their shares start to come down. And you have this all the spiraling up can be unwound very quickly and very dangerously in a crisis type of behavior. And that's exactly why this collusion is still sort of happening. So, for example, a few weeks ago when the markets were all spooked out, and there was a lot of spikes and volatility coming in, and you have these drops of 1,000 points in a day and so forth. What happened overseas? Well, the Bank of Japan came in and they dumped billions of dollars into their own stock market to make sure that it looked like somewhere things were doing okay with fabricated money. The European Central Bank went in and bought more corporate bonds in Europe to ensure that those companies that might otherwise have a problem, because let's say they're borrowing money in dollars and so they're exposed to a Fed hike, so they might have to pay back more if rates go up on the debt that they took out in dollars. So the European Central Bank said, we'll help you with that too. So they continue to try to sort of work around the edges of what could otherwise be a financial crisis that is being created and has been created over the last 10 years by the abundance
All right,
of
so
all of this fake money that's come from the central banks.
So you're telling me two things. You're telling me maybe one of two things here. One is that this artificial intervention is actually never going to go away because now the banks are in a position that they cannot allow the stock market to theoretically have a major correction. And even if that is the case, part two of that question is can they eventually stop it anyway?
Well, that's the scary question. I mean, if it were to happen, and this is their fear, they're in this catch-22. If they raise rates too quickly, so the Fed will talk sort of big about growth and everything else, and even though those growth figures aren't what actually winds up happening in real growth, they still talk like this whole process has worked, like it's had the effect that they said it should have 10 years ago, which is to stimulate the real economy. So they have to kind of keep pretending it's doing that, regardless of whether it is or isn't. And at the same time, yes, if they move, and this goes back to why Powell couldn't come in and, for example, raise rates 50 basis points, because if they move too fast, they run the risk of upsetting this entire house of cards that's predicated on all of these major central banks having dumped all of this money into all of the markets very, very cheaply. And, you mentioned LIBOR before. One of the other indicators that happened before the 2008 crisis and is happening right now is there's been this really fast spike up in what's called leverage loans. So basically, not just loaning, but borrowing money to loan and borrowing money to loan. And these are other forms of sort of piled on debts. It's like, you go to a blackjack table and, you borrow $100 from the guy next to you and $100 from that guy next to him and then from his mom and his aunt. And it goes on down the line. And so you're losing all of those people. You're not just losing one. So that's kind of what these leverage loans are like.
Got it.
And they're higher levels now.
Nomi, I'm up on the top of the hour, so I got to get you, but I want to let people know how to get a hold of your book. Where can they go and get pre-registered and pre-order your book? On Amazon?
Well, they can do that. They can do it on your site, I think, Lance, because you are so cool. I gave you, I think, or I will, a link on your site where they can specifically, as your listeners, get a really good rate on pre-ordering that book.
Yeah,
so they can go to my site or your site.
I don't have that link, but if you'll send me to it, I will get it up for you. Absolutely, and I'll send you a copy of this entire interview as well. Nomi Prins, author of Collusion, thank you so much for your time. We'll have you back soon, okay?
Thank you, Lance.
Thanks, Nomi.